Good morning, everyone. Thank you for joining in. Sorry for the couple minutes of delay. We were just trying to see if more people are going to come in. But I think, given that there are quite a few people who are already here, let's choose to respect your time this morning and get started with the conversation that we wanted to have. So, today's webinar is actually going to be about uh, the changing macro landscape. So, we thought it would be an interesting point in time to sort of review what has happened in markets over the last 10, 15 years and get a sense of where we are today in the context of history. What are the things that would change going forward, or what are some of the big trends that we're seeing on the saving and investment side, which are affecting investors like you, right? So, this is where we wanted to focus our energy and time today. So, thank you for joining in. Thank you for being part of this conversation. If you have any questions, please feel free to type it into the chat box or into the Q&A section. I'll be happy to take it towards the end. The way that we've structured the webinar is to keep maybe 30 to 40 minutes of time for presentation and another 20 to 30 minutes for Q&A. We'll try to stick to this format. We'll answer as many questions as possible. So please do put in whatever is on your mind if you have some questions or comments. After all this, we'd like this to be as interactive as possible. So let's get started. Um, so one thing that we wanted to look at in terms of macros was to look at the big factors, right? So whether that's government finances, whether that's inflation trends or growth, these are the three big things that pretty much all macroeconomists really talk about. We also wanted to look at the RBI's forex reserves because that gives us a sense of how um, you're seeing currency also move. And the big game changer, which is what we've really been paying a lot of attention to, is how people are saving and borrowing today, because that is affecting uh, the opportunities in the market. And I think it's an important time to really reflect on what's going on there and how we as investors can be more aware of these trends. So I'll start off with the fiscal deficit because this is the key part of government finances. And when we look at the last 10 or 11 years of fiscal deficit trends, you can see that there's been some effort to consolidate your borrowings, right? So you've had from 2014 till maybe 2019 a very steady decrease in your fiscal deficit. And then, of course, because of the COVID years, you did have a lot more government spending happening. And now, again, we are on this path of fiscal consolidation, right? So you are seeing a certain level of a reduction in overall government borrowings. But I think one of the things that we need to be aware about is that some the nature of your investments or your deficit is changing, right? Primarily because you've got additional flows of revenue for the government, and we'll look at that shortly. But I think one important event that we're all going to watch and we're all going to track is the budget that's happening end of the month. So that will give us a sense of how the fiscal deficit trends will move going forward. Uh, I think so far, from whatever language you're hearing from the finance ministry as well as the government, it does look like they are committed to following the path that they had set out post COVID. But of course, there are also rumors about state level spending and certain looser fiscal policies. So we'll have to take a call on how that's playing out depending on the finer details that are coming out in the budget. So another deficit that we'd like to track is basically your current account deficit. And why are we looking at CAD? Because essentially CAD gives you a sense of how you're doing in terms of global trade, right? So, what are our imports? What are our exports? Are we dependent on certain things? Are we not? So, for India, the biggest two elements that contribute to our imports are basically gold as well as oil. Oil has been very volatile in the last 3 odd years, partly because of the Russia-Ukraine conflict, partly because of your Israel-Palestine conflict, as well as OPEC's production cuts. But it's not as bad as it was right after the Russia-Ukraine war, but it is also fairly volatile. So you have months where it's trading at a good range for India. You have months where it's honestly not at the best spot. But the important trend is you've had certain um, initiatives like Make in India and the PLI, which are basically improving our capabilities as exporters. So, and that is reflecting in the CAD. So, we're really doing quite well compared to historic levels. And you are seeing more positive trends in that direction as well. So, this is an important thing, and it's really good in terms of yields for a fixed income investor. If your current account deficit is narrowing, and I think that gives you more confidence and opportunity. And it is something that other investors would also look at as an important macro input. So moving on to government finances, revenues are certainly growing. So what we try to plot here is GST collection and direct tax collection, as well as the RBI dividend. Now, the RBI dividend has been a large number and it's occupied a lot of headline space in newspapers. But if you look at comparatively, it's not really contributing that much. So that's why we chose to plot all three of these together. And this is publicly available data. So you can also play around with it and try to see what those numbers are telling you. But the key trends to watch out here are that your GST collection numbers are growing really well. And so I think the original target when the July 2017 reform rolled out was that you would have, you try to get about 1 lakh crore per month. And we've crossed that threshold number. Uh, and your direct tax collection revenues are also going up. You have had certain measures in terms of ease of compliance because now you have the new regime for the new tax regime where investors don't really have to submit any forms or make any claims, and they're getting the benefit of lower tax slabs. But of course, you don't get the benefit of deductions or from your income. So you are seeing a shift in that trend as well. And these have been mostly positive shifts. Uh, and of course, the RBI dividend is based on surplus. It's not something that's a given in any particular year. It depends really on how the RBI's finances look and what they can afford to give to the government as a dividend. So one thing that we wanted to look at with respect to inflation is about the big change, right? We're not really going to delve into the numbers because that is something where you get a lot of publicly available information, where there are a lot of commentary on where we're standing with respect to inflation. So at a high level, what is coming from the RBI is that of course they've made a lot of progress from the time that you had this spike in inflation post COVID, and we have brought inflation below 6%, right? So you do see that in the last few readings, you're not really at 6%, but there are a lot of risks that would push inflation up at any given point, right? The key one being, of course, the monsoon, because uh, there have so even in the last year or so, inflation hasn't been completely under control. What has happened is you've had a mix of supply side measures also, which have brought inflation down. And what you're also seeing is that certain things, especially food and fuel, have been more volatile than other elements, right? So and they are important elements in the basket, which essentially means that you want to keep that also under control. It doesn't make sense to say that, oh, I've taken out the volatile components and then I'm still meeting my target. That's not a very practical way of looking at inflation. And if you look at other central banks also, like if you look at the US, they do talk about price stability because price stability helps everyone in the economy participate and benefit better, right? So the key thing is for a long time, India did not have a focus on managing inflation. So if you go back to 2012, 13, you would see these huge spikes in inflation, and then you would see very aggressive monetary policy actions that were used to rein them in. Whereas if you look at what has happened since the inflation mandate was introduced, which was in 2016, right? You have had periods where you've been able to maintain inflation, maybe not at 4%, which is the long-term target range, but closer to 5%. And then, of course, because of COVID, you have had these massive spikes, and you are seeing so for the last few months, we've actually had deflation in the WPI side, right? Because essentially you started with a much higher base, but now you're seeing that trend also pick up, and your core inflation has been steadily coming down. So these are positive trends, but at the same time, the RBI is quite watchful of what is happening on the inflation side because one, it's not just a domestic phenomenon. If you're having global inflation, then that can get imported into India as well. Two, you do have monsoon. So if you're tracking the news almost every day, the headlines are different, right? So at the start of the year, there was a lot of concern that this would be an El Nino year and we wouldn't have enough of rainfall covering key regions in the country. Then you had, like prior to the monsoon, the narrative shifted to more of a La Nina year. Then on a daily basis, you've been getting updates on which areas have got enough rainfall, which areas have got less rainfall. And you're also seeing this phenomenon of heat waves affecting agriculture as an industry. And of course, the monsoons have a good bearing on rural recovery, etc. So, as of today, the monsoon story seems more or less intact, but keeping track of where that is heading, and that is more of a continuous and iterative process, is going to give you a sense of what is happening on the inflation side as well. So the third slide, the next slide that we wanted to look at was with respect to growth. So this is our next macro factor that we wanted to focus on. And if we look at this is data from the World Bank, so we went all the way back to 1960 to see where we were, and we thought it would be interesting to sort of categorize our growth ranges into phases, right? So anything say 1 to 2% and below is not really good growth. And that band of say 2 to 6 is okay, you're still in the growth territory, but they're not really great numbers, right? But 5.5 to, I mean, 6 to 8% is actually a pretty good zone to be in. And if we look at what the RBI governor has said, what are growth, so the whole of last year was really just about the India growth story, right? About how, despite all other economies degrowing, India was in that one phase where we were actually growing. We didn't have too much baggage from the pandemic. And we've done consistently 3 years of, or we're going to get into our fourth year of 7% plus growth. So we're still in the expansionary phase of the cycle. And we've been doing this with fairly neutral, or if you want, even maybe slightly restrictive monetary policy. So there is a space for us to ease and support growth. There is also enough momentum and growth for you to not change anything on that front. So we're actually on a very good wicket as far as growth is concerned, especially post-COVID. I think pre-COVID, we were heading into a slightly sluggish phase in 2019. So if you go back and if you're able to access any newspaper archives and you look at, prior to pandemic commentary, what people were talking about India in terms of growth, there was a little bit of concern that we wouldn't be growing at the same pace that we were growing at the previous few years. So with this bounce back, you're also seeing broader participation. You did have uh, some talk about this K-shaped recovery, which is that the more affluent segments of society were recovering and growing faster than the less affluent ones. And now, if you have again some support plus a good monsoon and these kind of initiatives going towards the rural economy, you are likely to see a more balanced recovery or a more broad-based growth, right? So these are interesting elements to look at for us in terms of the macro story. And again, to the last couple of things that we want to look at from the first part of our agenda is that one, we wanted to look at how the FX reserves have grown. So the RBI has been pretty proactive in steadily growing their foreign exchange reserves. And you can see this from 2018 till 2024. That's the data we took out from the RBI website. But of course, you can go back way further in time and try to extract data from that as well. So the important thing is that we are at historically high levels in terms of what we have as total reserves as well as dollars or foreign exchange. The interesting thing that we've noticed is that the rupee has been pretty stable in this cycle. So if we look at what has happened with the rupee, you've seen more or less it trade in this range of 83 rupees for the last year or so. Now, you might feel like there has been some change and it's not been stable, but we need to keep in mind that the US has hiked interest rates multiple times in this time frame, right? In the last 2 years, you've had multiple interest rate hikes, and the rupee hasn't responded with any deep volatility to those interest rate hikes. And that tells us that there is some stability in the rupee because if you didn't have that, right, like if you had response or reaction to how the rupee to US interest rates or advanced economy interest rates in general, then that would show us that the rupee is not actually been that stable. So I think the current account deficit, uh, as well as generally other macro factors and the RBI's intervention has actually contributed to more rupee stability and more predictability. Now, one interesting trend is that central banks, including the RBI in India, is of course in the top 10 central banks that have added to their gold reserves in the last year or so. But India has been consistently buying. So this is a trend for the last maybe 5 years since 2018, 5 to 6 years, where you're seeing this, right? Where gold reserves are just going up. And here we are at 4 lakh, maybe even above 4 lakh crores today in terms of gold reserves. So this has been a massive, so you're seeing almost a massive like 3 time jump in the last 7 years in terms of gold reserves. And this hasn't really, this isn't like an India specific phenomenon, by the way. This is something that's happening across the globe. So if you look at data from other central banks as well, you would see that there has been this shift. Of course, one major trigger was the Russia-Ukraine war because then you had a lot of emerging market central banks realize that overnight their dollar assets could get frozen, and having access to some form of wealth was important at that juncture. So you did see some shift away from this. You've also seen it happen primarily because of the massive inflation numbers that have come out, because gold is a store of value, and unlike something like an exchange rate, it's far more stable in terms of telling you how much you actually have. So these are very interesting trends, right? That we do need to keep a look out on. They give us a sense of what's happening macroeconomically. They give us a sense of how central banks are thinking about the problems of today. So with that, I'd like to move to the next section, which is about new ways of saving and spending today. So if I'd like to start off with saving as a percentage of GDP. And this is something that came out in the Hindu, where you can see that clearly in the last decade or so, your savings as a percentage of GDP has really come down. And this is broad savings, right? It's not just financial assets or real assets, it is everything. And you're seeing physical savings sort of go up a little bit in the last 4 5 years, and your net financial ratio is coming down. So why is this happening? Because what we are really hearing is that there are so many demat accounts being opened. There are so many SIPs that are running. The mutual fund AUM is growing up. It's basically because debt or loans have a much bigger share of the pie, right? So when you look at how debt has occupied more space, you see that people have become more indebted. And one part of this is because maybe during the COVID years, you suddenly had more financial stress in multiple households. You also had lower costs of borrowing. So people did borrow more in that space. But that picked up only later, right? So those are 21, 22 trends. But you did have this massive a sort of spike in debt as a percentage of your uh, GDI uh, go up from maybe even 2016 or so. And I think this is because accessibility and fintech has really picked up. So you do have this entire ecosystem of NBFCs that have been accessible to multiple households. You do have people who've seen more income from a family level or generationally. So there has been more borrowing that has happened. At the same time, you're also seeing your savings and physical assets change, right? So mutual funds have really been in the limelight as far as investors have been concerned. So if we look at trends all the way from 2008, right? Uh, Back in the early phase, people were more interested in debt and liquid schemes than equity. So you can see there were years where equity didn't really contribute to net inflows at all, right? Especially in your global financial crisis phase, you did see money move out of mutual funds overall, and you saw industry AUM shrink. And then that outflow from equity continued to happen until about 2015. So only in 2015 you started seeing money come into equity schemes, and there was a very small amount of flows that were coming into passive funds. Now, if you look at the trend of passive funds over the last few years, that is, if we look at the last decade or so, from 2016, 17 till now, you're seeing the share of passive really go up quite a bit, right? You're seeing the share of debt come down drastically since the change in taxation. So if you look at 22, 23, your debt and liquid schemes have really come down. The money has flowed out of fixed income into equity as well as passive. And you're again expecting some money to go into liquid and debt in the coming years. But we're actually not seeing, like on the ground, like when we're talking to investors, we're not actually seeing that traction, right? People are still skeptical about what debt could do for them. Investors are very comfortable with the kind of returns that they've made in equities. So that allocation shift has not happened mentally for many investors yet. And SIPs have, of course, become a much more popular choice because you had, uh, I think our AUM book is almost at 21,000 crores for the industry in May, right? So if you look at how much SIP contributes in terms of AUM, it's almost one third of the AUM, which is a pretty big number because that means most investors are choosing SIP as the form of as their preferred mode of investments. But what is a little bit worrisome in terms of how these SIPs are growing is that your net additions are coming down, and the number of SIPs that are getting discontinued are also stopping, right? And the purpose of so if we look at the right hand graph, that would sort of give you this data. So the new SIPs are the gray bar lines, the discontinued SIPs are the red bar lines, and then you have the net additions, which is your red line that's moving through the chart. Now, if your SIPs are getting discontinued and started in other schemes, then you're not really actually benefiting from the advantage of working with an SIP. So it's very important to choose the right fund and to be able to stick through that fund for a full cycle, because that's when you get the full effect of compounding. And yeah, so I think this was one trend that we wanted to highlight. So there has been some level of stickiness as well, which is if you look at the age-wise AUM, right? If you see the share of AUM that has been around for more than 2 years has actually picked up. And you're close to maybe 40-45% of your AUM is more than 2 years old. Maybe another 20 odd percent is about 1 to 2 years old. And then you have the remaining maybe 30%, which is basically less than 12 months, right? So this needs to be stickier. Like, we would like to see data where people stay invested not just for 2 years, but for longer than that, because that shows that a more investor mindset rather than a speculative mindset. And it's important to see this change because you are seeing the regulator come down on speculation. And we'll talk about that as well, right? So if we look at the massive leap of faith that retail investors have taken in the F&O market, you'll see that the index turnover for F&O was about 4.5 lakh crores in 2018, right? And today that is 140 lakh crores. That's a massive, massive jump. It's not 5 times or 10 times. It's much, much more than that, right? You're seeing maybe even 30 times or more than that in terms of turnover. And turnover is essentially a function of trading, because that's the kind of volumes that you're seeing. And if we look at retail as a category, how much they used to participate in 2018 was they contributed about 2% of the pie. And today they contribute about 41% of the pie. And of course, this has come in because of platforms that have enabled ease of transaction, that have enabled costless transaction as well. And this was something that regulators, advisors, and generally a lot of people have been quite wary and cautious of. So you've even had the regulator come down and say that there is a large amount of money that is going from household savings into what is essentially not productive economic activity. This is speculative. This is not going into any capital formation in the country. So what she's trying to say is, when you're doing these speculative trades, you're not actually contributing to the economic growth. You're not contributing to deepening the financial markets. You are just contributing to something that could become a problem for retail investors in the long run. And so I think you've had one announcement this week, which is pretty big, and I'm sure everyone has gone through that in terms of how zero broking is no longer going to be allowed for the F&O segment. And we've already had the platforms come out and say that it would not be viable to provide those services for free anymore. So there will be some shift that is happening in terms of how people are using the markets for these activities. So lastly, we wanted to look at the flow show, which is where is the money actually going? And we thought we'd look at how FIIs have been behaving in this market. So if we look at FII flows from, say, 2017 until now, then we do see that in the last, so we've had a pretty good run through 2022, 23. But this year, you've seen a lot of profit booking, and only in the last week or so you've had um, the FIIs come back as buyers, but broadly they've been a little bit cautious on valuations, and that is evident in their commentary as well as their way in which they participated. But where are FIIs actually bullish? And if we look at that, it's actually with um, fixed income. And there's a very good article written by someone from the World Bank called India's Bond with the World. You can Google it and it'll take you maybe like 5 to 10 minutes to read, but it will give you good insights on how India is positioned in the global context. So the big news from June was the inclusion in the JP Morgan index, and the India's weight would go from 1% to about 10%. And when that happens, the idea was to do it as 1% per month over a period of 10 months. And the weight would basically involve a volume of maybe 20 to $25 billion in net flows. Now, some of that activity has already happened prior to the June index inclusion date, because you have seen FIIs buy debt from the time of the announcement, right? So that is September last year. So we'd have to see whether the net inflow is coming up to about 20 to $25 billion in the next 10 months, or if it's going to be a cumulative thing of what has happened from the date of the announcement, right? But ideally, this is the biggest flow that is going to happen into Indian bond markets. And then we have the Bloomberg index inclusion, I think, with the emerging markets index. And that is expected to take place again over a period of 10 months between January and October next year, right? So again, here it's about 1 to 10% in weight, but I don't think this index is as large as the JP Morgan one. So the volumes are not really going to be in the 20, $25 billion range. Um, and of course, the last is that you have the FTSE index, which is not yet confirmed, but there was some talk about whether that index inclusion would happen as well. And that is going to happen over a 5 year time frame. So I think from an FII perspective, there will be flows that are coming in from different indices, from different sets of investors over the next 4 to 5 years. And that could change the demand for Indian bonds as well. And of course, with that, if your yields are coming down, there is some potential for mark to market gains for investors. But you've seen a fair amount of that already happen. So, how much more is left is still a question mark for a lot of people. So, I don't want to actually conclude with any specific statements. I would prefer to hear what you think. I would prefer to address the questions that have already come in from both YouTube as well as the chat box. But please do share your thoughts, and let's keep this conversation. All right. Okay, so which sectors such as gold, silver have good future, the effect on the debt funds in the coming time? So if you ask us now, we believe as a house for both Finesse as well as M2W or even ithought, we do believe in following an asset allocation strategy, right? Specifically for mutual fund investors, which is that it makes sense to have some allocation outside of equities. There are selective pockets of equities that are still quite attractively valued today. Uh, you do have broad-based expensive, wherever people are talking a lot, right? Those parts of the market are quite expensive. So you do want to shift out of that. Gold, silver are good investments. We are seeing even central banks like the RBI treat them as good investments. So why should we treat them any differently? Similarly, for debt, also you're seeing FIIs put in money into debt markets. So you know that's where the smart money is going. You know that there is some value in what they are doing. So I think that should answer the question. There is merit in looking at asset classes outside of equities, which is not to say that you cannot make equity investments in today's market. I do think that there are quite a few pockets where you can be safe as well as uh, manage those investments pretty well. As a retail investor, what are the key microeconomic ratios and how can we equate them with sectors? Well, see, micro is actually much more nuanced than macro, right? Because it depends on each sector. So you would have to understand what are the key drivers for particular sectors, and you would have to manage and monitor that independently. I don't think there is a broad framework as such. Okay, what is the effect of stock market having higher interest rate for longer periods? I think interest rates may go not go down in the near term. So if you have higher interest rates, it obviously will one affect companies with borrowings because companies that have debt on the balance sheet will continue to service debt at higher rates of interest, which essentially means that maybe from a cash flow perspective, they don't have that much to reinvest. Um, you can also see money like capital can be raised by a company either through equity or debt, right? So if debt is becoming very expensive, then you can see equity capital getting raised. So from a shareholder perspective, that might have some level of dilution or change in ownership. So those are things that can happen. Typically, if you continue to have high interest rates, we are not. I don't think today we are actually at a very high interest rate stance because you are still having a decent amount of growth. Uh, you're not having a slowdown as such. At the same time, you're not really having inflation come out of control, right? So a high interest rate scenario would typically also have higher inflation than where we are today. And if that happens, then again, you can have some impact on margins, and you can also have some costs getting passed on to consumers. So then you might have volume degrowth. Those are all after effects based on the secondary nature of the higher interest rates, right? Why are interest rates higher? We have to answer that question and then work from there. Typically, you would have to look at inflation as your base point as well as cost of borrowing. Okay, so one more question from YouTube. How banks sustain as people moving very fast from debt funds and FDs? What will be the ideas to sustain? This is a fantastic question because I think everyone is trying to answer that today. You do have the regulator talking about how your credit to deposit ratio is not really at the level that you want it to be at. You're not really getting in deposits because money has moved out. So we did look at that trend, right? In terms of how it's happening with mutual funds. But I think in general, debt has become quite unattractive. People don't want to put money into debt, whether it's in the term of bank deposits, whether it's corporate deposits, whether it's debt mutual funds. You're seeing money only flow into the higher, riskier parts of debt. So maybe individual bonds with lower ratings, as well as credit strategies like AIFs. That is where debt money is going. And the AIFs themselves are targeting a return range between 12 to 18%, right? Those are equity kind of returns. So it is a problem, and there will have to be some action. I think I mean, there will be or there can be regulatory changes that would influence the way that we look at debt and equity as asset classes or even deposits as an asset class. Possibly, if the cost of deposits goes up, then maybe investors would be incentivized to participate. So we don't really know what is going to happen, but it is something that both the RBI as well as SEBI uh, are paying attention to. So it will be interesting to see how they respond to this challenge, but there are many, many ways in which they can do it. What is the possibility of the RBI doing a rate cut before the US Fed does a rate cut? To be honest, I think one thing which came out very clearly in the last RBI policy is that they are not following the Fed, right? And yes, to a certain extent, you do have to uh, give weight to global macro factors, like what is happening across the world. Does it make sense for us to, change our interest rate stance based on that? But I think currently where we stand, the Fed is sounding a lot more dovish than they were, say, a month ago. They are being a little bit more cautious as well, and they have factored in, or the committee expects maybe one rate cut to occur in 2024. From what we are hearing from the RBI, I think inflation is still a worry. So I don't see them cutting interest rates, primarily because, see, we don't have a growth problem, right? We're still on track for a good level of growth at these interest rates. We don't also have an inflation problem. So I think we can be in this neutral zone for a while until either one of these factors moves out of the comfort zone. Whereas for the US side, you are seeing already some level of degrowth that is happening. You are also seeing very high cost of borrowing and very high borrowings, right? So even to service the debt that the Treasury has, it would make sense to have lower interest rates in the US so that they're able to maintain that. So I do think in terms of chronology, it makes more sense for the US to cut rates before the RBI. Uh, but of course, that is subject to inflation being at the level that the US is comfortable with. The last couple of prints have been promising, but Jerome Powell, their chairman, has basically said that you don't want to rely on one or two readings to make a policy decision, right? I need to see a clear trend, and there needs to be sustainable, a reasonable amount of confidence that the Fed themselves have that they have made good progress on inflation. So that's my personal view based on the data that we have studied. The valuation of Chinese equities are far below than ours. Will it affect our valuation sooner or later? Any idea to involve outside India investment? Um, See, I think globally also there are some I mean, FIIs do recognize that the Chinese markets are not that straightforward, right? They are going through certain things that require more attention. They've had that real estate cycle correction. They've had a um, their NBFC sector essentially. So I think selectively, you have to be very selective about China. You do need to read the signs. You do need to understand how the world is thinking about China, but yes, at some point, if your Indian markets become extremely overvalued, other emerging markets are much better, are offering much better value, you will see flows move out from one market to another. That is inevitable because eventually it is a balance between risk and reward. I think you need to be careful when you're doing sectoral funds in general, right? You need to look at the valuation, you need to look at the cycle. There are many things that you have to address and review before you make an investment. If you do want more guidance or portfolio specific questions, like we can take it offline if you're an investor and we can help you work through that. What about equity savings fund, which are 35% equity and 65% debt? Shall I consider this instead of pure debt for 2 to 3 year time horizon? And kindly mention about its taxation in short and long term. So I think if you have about 35% equity, you would fall under the 20% with indexation for 3 years, right? That is the case now. As far as taxation, I mean, it is going to be slightly more tax efficient than, um, let's say, a pure debt fund where you will be taxed on your slab rate. Again, see the thing with most of the hybrid categories, which we are quite cautious about, is that one, when you're dealing with a hybrid category, the only guidance that comes is in terms of the percentage that goes into equity and the percentage that goes into debt. There is no guidance on what is the nature of the underlying, or what is the quality of the underlying equity portfolio, what is the quality of the underlying debt portfolio. So for the risk profile match to happen for an investor, right? That is very difficult. You actually don't have any control over that. So it's much better for you to keep these things separate, where you know the quality of the portfolio, you have a clear risk profile match, and there is some clarity on what the mandate is as well. Right now, what typically tends to happen is somebody who's a conservative investor in a very high tax bracket would look at these hybrid funds so that they can actually uh, get that additional tax benefit, but also maintain the safety of what uh, they are doing, right? But you need to be clear about whether that is actually what you're getting or that is what you're being told that you're getting. We prefer to keep equity and debt separate. That way, you also have a slightly longer term horizon for equities, and you have that shorter and more flexible horizon for fixed income. Today, fixed income as a category is giving you pretty good yields even in the short term space. If you are interested in a more tax efficient short term investment, you can look at something like an arbitrage fund, which has equity taxation as well. Again, there you need to look at the right time to lock in because the yields are continuously sort of evolving. I'm sorry, we are not involved in brokerages and we don't do that. So I would not be able to share a list. No thoughts on shares as well. Sorry. I think there are a couple of questions in the Q&A, so let me just look at that. It seems that the government, especially the current one, doesn't respect experts in economic subjects. There is allegation of data manipulation. All arguments or perspectives are based on data. See, I think uh, I'm not really an expert to comment on that because I don't know uh, what exactly you're talking about. Of course, there are different ways in which you measure the same thing. And if you look at certain things like inflation, etc., you will see that the numbers that get reported versus, let's say, your own day-to-day bills are very different, right? So, but if you look at policy level, what they are doing in terms of managing inflation, you're not reducing interest rates based on a reduction in your inflation numbers. You are still participating in a lot of supply side measure interventions. So I think it really depends, and we need to understand that there's a difference between what comes on paper, what is data versus what is reality. And you need to look at whether policy is tracking reality or whether policy is tracking some academic data. So I think that is where you would have to look at things. But I'm personally not aware of any data manipulation. If you can share some resources, I'll be happy to look into it. Gopi, do we have any other questions from YouTube? Okay. So, with that, I just wanted to leave our contact details. If there are more questions, I'm of course happy to answer them. Uh, we do have a community on WhatsApp for Finesse where we share a lot of fixed income updates. You can message us at this number and we can add you to the community. We also do have a program called Milestones to Wealth, where we work with investors to get them from where they are to 1 crore in savings. This is a broad-based program. This is for anybody who's keen on saving. And the idea is that we'll handhold you through this process. We'll help you understand what are the best habits to cultivate, and we'll guide you to getting past each of the milestones that take you to about 1 crore. I do see one more question. Let me try to answer this. Macro effects like ongoing war in Ukraine, Russia, and Middle Asia, as well as sea route cargo transport disruption, still market has not fallen. So our market becomes fail-proof for these macro effects. No, I think, see, there's been a lot of optimism. There's been a lot of money that's come into the markets, right? So you're having your SIP book grow by a large volume. You're having, so if you look at, this is the first time in historically where domestic institutional investors have been able to keep pace with foreign institutional investors, right? In terms of flows. So your DII buying has been as strong as your FII selling on the days that the selling has happened. So you've not really seen the market move up or down on bad days. Um, And then you have this continuous flow that is coming into the markets through the mutual fund route. You have a lot of speculative activity that's happening in FNO, and you have the mentality that equity should give you 25 to 35% returns, because that's the kind of returns investors have seen in the last 3 4 years. So that has become the new normal, but that is actually not normal. And this is something, if you're following our pages, you'll see our update on fixed income that will come out this month. This is something that we spent a considerable amount of time talking about, which is that certain things are not normal. Investors are taking them for granted, which means the day that investors realize that that is normal, you will see a very violent reaction because they're not used to it, they're not mentally prepared for it, they're not financially prepared for it, right? So today, the most important thing for an investor is to actually prepare, and to prepare with the mentality to manage risk effectively, to be ready for the next opportunity. That is not really happening. People are just focusing on the same opportunity again and again without realizing that there can be changes, that the future is not going to look like the past. We still have about 5 to 10 minutes, so I'm happy to take any more questions. Uh, you can click on this link if you'd like to be part of our WhatsApp community. We share a lot of interesting insights on what's going on in the fixed income markets. We also conduct webinars every month, like this one. We try to keep it interesting. We don't repeat topics, and we're happy to take your feedback on the webinar as well. So if you have any thoughts or comments, do let us know, and we'll be happy to work on it. Okay, then let me just thank everyone for coming and participating today. You've kept the conversation going. Uh, it's been a good opportunity for me also to think about things that I've not really seen before. I don't think the next opportunity always has to be a crash, right? You can also look at the next opportunity as something where people are not paying any attention to, because at the end of the day, the whole I thought and philosophy is based on both value investing and contrarian investing. So it has to be either, if the market corrects, we might get an opportunity into certain segments that are currently overvalued. You can have a crash also. We don't know. These are things that, I mean, you know that the market is overvalued. That can be a time correction, which means there won't be any crash. It can be a market correction, which means there will be a crash or a reduction in prices and valuations, and then gives you a re-entry. So we never really know how these things are going to play out. We only know that they are going to play out in some fashion or the other, and we can only prepare for that. So that is what I was trying to say earlier as well, that the most important thing is preparation today. Many people are not spending enough of time on preparation. In my opinion, I think there have been a couple of changes, right? One is you've had very good returns from equities, and those returns have been consistent. It's not been 1 year of good equities, 1 year of average equities. You've had 3 years of consistently good returns from one asset class. At the same time, you've had this change in taxation for debt. So people who are preferring debt at some point with this idea that I'll keep that money for the long term for 3 years with indexation, that has now, you've had an entire category of investors just leave because of the tax difference between equity and debt. So that, I think, is basically also contributing to the issue, because people are also tracking post-tax returns, right? People are not just looking at pre-tax return. So I think both of these have been key drivers in sort of moving money out of debt into fixed income. And now, if you're getting very high returns from equities, then 7-8% doesn't look very attractive, right? And we've had investors say that to us. They've said that, oh, only 7%, only 8%. No, I will prefer to keep an equity. I am a long-term investor. Then this argument of previously the FD investor would keep their entire long-term savings also in fixed deposits. Now they're saying, oh, if I keep my money in fixed deposits, that's not helping me with long-term wealth creation. So you do uh, have this mindset change that has happened. How can we evaluate GDP growth? Yeah, you can just use the main components of GDP, right? Which is, are you saying consumption? Are you saying investments? Are you saying net exports? What is it that's really contributing to GDP? Ideally, investments are good because investments actually give you multiple uh, stages, right? In the sense that investments also contribute back to GDP in the future, whereas consumption is more or less one time. It doesn't have any ripple effect or positive second order effects too much. Um, and then net exports, of course, that is one of the reasons why we looked at CAD, because you want to see how you're doing on that front. You want to see where you're contributing and all of that. Data is only to guide us. It is not the end result, right? So you try to consume a little bit of data. I think the most reliable sources are, your government websites. So RBI data is pretty clear. If you're looking at global data, World Bank has good, freely available data sets. So these kind of things are actually quite helpful because it allows us to look at official data, but even official data sometimes goes through revisions because of data collection lags and certain other things. But keep a simple framework. You don't need to track too many things. Okay, I think it's 11. So thank you once again, everyone, for being part of this. Thank you for spending your Saturday with us. I know this is a fairly heavy topic to discuss on a weekend, but you've all been very kind in participating and asking questions. So we're happy to be able to do this for you every week. We have another set of webinars happening today and next week as well. So we hope to see you soon at one of our webinars. Thank you.